Welcome to Passive Investors Playbook. I'm your host, Charlie Hardage. In each episode, we'll sit down with successful people that turn to real estate to build and grow their wealth. We do a deep dive into why they chose real estate and what makes it so attractive to them. We explore why people in their industry could also benefit from passively investing in real estate. Whether you're a beginner or an experienced investor, a doctor or a professional athlete, love your job or hate your job, our show is here to help you build a profitable real estate portfolio while maximizing your free time and minimizing stress. So sit back, relax, and get ready to learn from some of the best in the business. Welcome to Passive Investors Playbook. All right, so on this episode, I sat down with Brian Head. Brian is a multifamily syndicator. He opened a fund, which is awesome. I love how he's doing his fund. I've never heard of anything like it before. So you definitely got to check that out. But Brian had his start with a extremely large financial institution, did that for a while, and was in real estate the whole time, but has really taken off the last few years. Brian has an awesome story. Can't wait for you to hear it. Thanks for listening. Hope you enjoy the episode like I did. Hi, everyone. Thanks for listening. I'm Charlie Hardage. I'm the host of Passive Investors Playbook. Today, I have on the show Brian Head. Brian is the founder of Head Start Equity, a real estate private equity firm that provides passive investment opportunities, primarily in value-add multifamily properties. Brian has over 20 years of experience investing in real estate and is currently invested both actively and passively in almost 2,000 doors across 19 properties with a value of over $350 million. Brian has a bachelor's degree in finance from UTSA, that's University of Texas at San Antonio, and worked in the financial services industry for over 25 years. 10 of those, he was a licensed investment advisor and stockbroker. Brian, thank you so much for being here today. Super excited to have you. Do you mind telling the audience a little bit more about yourself?
Sure. Yeah. Thank you for having me on. It's an honor to be on your show, man. I appreciate it. So born and raised here in San Antonio, Texas. Yes, been here all my life. Married to two kids, one 5-year-old daughter and a 12-year-old daughter. I know we've got daughters around the same age. So they keep me. They definitely keep me and my wife pretty busy. But yeah, you kind of mentioned it there. You know, I started at a local large financial services firm here in San Antonio, worked there for 25 years, right at 25 years, left actually just a year ago this month. And to pursue the real estate thing full time. Real estate's always been my passion. Like you mentioned, I've been investing in it on the side for over 20 years. And so actually, just posted something on LinkedIn today about my very first flip that I did. I was just kind of looking at those pictures, reminiscing about what that was like and the fun and the not fun part of it. But it was great learning experience, and wouldn't change a thing. So,
and that's awesome. I lived in Alamo Heights in the late 80s for about 18 months, and I've been back to San Antonio many times. It's definitely changed over the years, which is a good thing. I know they cleaned up the Riverwalk, and San Antonio is growing very quick now, which is funny because it's kind of always been a big city with the Alamo and all that, but growing like crazy. And then I know you mentioned that you've been in real estate for 20 years or so. How did you get into real estate? You mentioned it was a passion, but how did it become a passion?
Yeah, so I think really investing in general was kind of a passion, and I kind of developed that passion, I guess, in high school. So I had an economics teacher who had us track stocks and things like that. Back then it was in the paper. There was no internet at that point. So we were just kind of tracking those stocks and those investments to see how they did. And, the whole idea was to kind of learn about the markets and things like that. And so that actually, I think, was one of the first kind of bugs that got planted for me in getting interested in investing. And so as soon as I graduated high school, I started going, I can't updating myself, but going to the library to check out books and stuff to learn all I could about investing. And initially it was really all around investing in stocks and mutual funds and different things like that. So the public market type things. And that was my initial interest was in that. And so it wasn't long after I graduated that I pursued a career in the financial services industry, went and got my securities licenses and did that for about 10 years. And so that was a lot of fun. That was kind of my first exposure to investing in general. But one of my very first investments was my dad was like, you need to just go buy this is when I was living at home, so I think he was probably just trying to get me out of the house, but it was good advice. But he was like, you just need to go buy a fixer upper, right? And I'd had my job at the company for a while at that point, and so I had credit and all that stuff, and so I was able to go out and purchase a HUD foreclosure. So that was my first investment property. And house hacked it, rented one of the rooms out to a roommate, a coworker that I worked with at the time. And so that was kind of my first foray into real estate investing. And then kind of did the single family thing from there. The typical story you hear of a lot of investors starting out in single family rentals and flipping, small multifamily. Then I got into a duplex and a triplex, and then started even doing a little bit of Airbnb properties as well, just exploring a lot of different things. And then a few years ago is when I kind of took the leap and started getting into these larger multifamily deals of 100+ unit complexes. Just knew that had some personal life event happen with my wife and everything, and that was kind of the impetus for just taking that leap and going out there and going for it. And so kind of that's what I'm doing now.
Man, okay, so your dad basically tried to kick you out of the house, is what you're saying. But
Yeah.
the good thing, and obviously I'm joking there, but the good thing is he did kind of nudge you in a really good direction. What do you think the reason that he told you to get a house was? Is it truly because he wanted you to live on your own, or do you think he knew, hey, Brian really likes to invest, real estate's a good investment, or is it maybe a combination?
Yeah, I think it was a combination of both, right? So the funny thing is my dad is the hardest worker I've ever met in my life, like super hard worker. He's a tile installer. That's what he's been doing since he was 16 years old.
Wow.
And so he's done that his whole life. He's in his 70s now, and he's still doing it,
Wow.
which is crazy. I don't know how he does it, but and so he's never been the best with money. Ironically, I learned. Hopefully, he doesn't listen to this, but I learned a lot of things on what not to do financially from him.
Yeah.
But because of his job and what he did, he was always around other contractors, developers, things like that. So he saw the value in investing in real estate, and he knew that there was value there. And so that's kind of why he nudged me. One of the reasons why he nudged me that way. And so had he not done that, I wouldn't be where I am today. So.
And I know you mentioned you had a really good economics teacher that kind of pushed you to do investments. That was not real estate. That was just stock, mutual funds, markets like that. And then did you have any experience in real estate, or was it truly, hey, you should find a fixer upper and get to work and build some equity? Was there anything else that attracted you to real estate at that time?
I knew too, in doing some research on my own, that it was a good investment, but
Okay.
I didn't really have any experience. And I knew a few people. The realtor that helped me purchase it, he was a real estate investor, so he was able to give me a little bit of guidance as well.
Nice.
But yeah, it was a good learning experience. I mean, it was your typical rehab, flooring, paint, nothing too crazy. But yeah, I mean, I knew it was a good investment, but my dad kind of nudging me that way was really what got me started on that.
Man, that's awesome. And that's really good that you had a real estate agent that was also an investor, because I know I used to have my real estate agent license back in the day, and some agents say, "Oh, I'm investor friendly," but they've never invested themselves. So
Yeah.
that's good that you kind of had some extra guidance there. You already knew from your dad that, it's a good idea, and you had the background of investing anyway. So just kind of all came together. You, like almost all of my other guests, have, and myself included, started in single family. What was it about, and I know you, I wrote down a lot, but you did some rental, some flipping, some Airbnb. What did you primarily do? Or was it just?
It was primarily flipping and rentals
Okay.
and single family. That was really the things that I was most active in starting.
Okay.
Starting out in real estate. Yeah. And I learned, so I did some of the flipping earlier on as well. And I did learn that, and I kind of did both at the same time, but looking back, flipping is just, that's a straight up job.
Yeah.
I didn't do the work, even not doing the work myself on the flips, and just managing the contractors and things like that is a job. I spent so much time at Lowe's and Home Depot, and those were my second homes. And plus, from a flipping standpoint, right, and from a tax standpoint, flips are not the most tax advantageous thing to be doing, right? They don't give you those tax benefits that a rental property does. And so plus then you got to redeploy that capital pretty quickly again and find another deal. And so looking back, I think that rentals were probably the better way to go. I actually did some investing prior to 2008, and then picked up most of my single family rentals actually after that happened, because at that point there was a glut of properties, right? And so that was when I picked up most of my single family properties, and I actually still have a handful.
Okay, very cool.
Yeah.
So you said, I was actually going to bring this up, but you had a full-time job while you were flipping property. So you basically had two jobs. Yep. And the flipping, you were not doing the manual labor, but you're still managing the projects, the process. You're still probably finding the deals or underwriting them yourself. And so, you come home from work, from your full-time day job, to work on your part-time night job of real estate.
Yep.
And then you also mentioned something that I've not really even thought about when it comes to flipping, because when I think of real estate, I think, oh, real estate, so many tax benefits, right? But in flipping, it's not really, because you get a lump sum and you don't get to write off much of the depreciation, do you?
No, and it's taxed as ordinary income, and unless you hold it for over a year, which would not be good if you're trying to do a flip.
Right.
But yeah, if it's less than a year, it's not a long-term capital gain. It's short-term capital gain, which is just taxed as ordinary income. So, it's not, from a tax standpoint, it's not that great of a strategy. Now, don't get me wrong, you can do really well and make a lot of money. And there's plenty of people that when you scale it, maybe it's a really advantageous thing to do. But from my experience and the way I was doing it, it didn't. I probably did about a dozen flips. And so, I was never at that point where I was scaling and doing multiple flips a month or anything like that.
Okay.
Yeah.
Okay. So let's just talk about in general, why is real estate so attractive?
Yeah. And when you say real estate, of course, there's a lot of different types of real estate, right? Especially in the commercial space. But I think, when you think of residential real estate, which is really my bread and butter, and I think will always be my core holdings when it comes to real estate, the bottom line is people need a place to live. And after 2008, we definitely started experiencing a housing shortage, and that still exists today, this many years later. And so when you look at it from a supply demand standpoint, where we are in that cycle, there's still millions of homes that were short for the number of people out there looking for a place. And so that also helps from a rental standpoint as well. But it's a physical asset, right? So you can go look at the property. It has, like we mentioned, if you do it right, there's tax advantages to having real estate. The other component is, especially if you're doing it yourself, if you decide you want to go that route, you have more control too, right? You can control your investment and how it does. You can force that appreciation in that property yourself, right? When you invest in it, I'm not one of those guys that's going to come on and bash investing in stocks and stuff. I think that a diversified portfolio is important. So I think stocks have a place in people's portfolio, but if you're invested in stocks, you're not going to be getting on the phone and calling the CEO of the company and giving suggestions on how to run that company better, right?
Right.
You don't have that ability. So from that standpoint, if you want to be active, it's pretty cool that you can kind of force that appreciation and have control over, the success of your business. That is one of the cool things, and I'm sure we'll get into it in a little bit, getting into the multifamily and what I'm doing now and working with investors and things like that. But drawing that same parallel with stocks, right? People that invest with me in my apartment deals, they can call up the person that, one of the people potentially running the deal, depending on which investment they're in with me and things like that. And hear directly from the person that has influence over that as well. So, but yeah, I mean, I think there's so many reasons why real estate is a good investment.
Yeah, I definitely agree. And just for the audience, I'll just kind of recap those. I wrote down, I think, 5 kind of bullet points on the benefits that you like, Brian, about real estate. And one of those is the housing shortage. And there was a report that came out a couple of years ago from Fannie Mae saying that the decade of the 2020s, we're going to be short, by the end of the 2020s, we're going to be short about 6.5 million housing units. So we're already in a housing shortage, and it's actually going to get worse, not better, over the next 7 years or so, unless something drastically changes, and I don't see that happening.
Yeah.
You love that it's a physical asset. I do too. Tons of tax benefits with it. Diversification from the stock market and from more of the quote unquote traditional investment opportunities. And then something that you brought up, which I also love, is more control. You mentioned calling a CEO of a company. Well, there's a lot more steps before that too. A lot of times you go to your financial advisor. Oh, I don't know. This is kind of what the algorithm says, or this is what we or the analysts are saying. Okay, call the analysts or call the mutual fund managers. You're not going to talk to any of them really to get an answer. And so I love that about real estate. There's a lot more control, whether that's single family or multifamily. There's way more control there. And I do actually want to get into the multifamily side, because I know you said you did a lot of flips. You've done some Airbnb, some rentals. You still have 5 single family properties. But how did you get into multifamily?
Yeah, so multifamily. I mentioned that I had a life event that took place. So back in just for full context for those that listen, back in 2008, my wife was diagnosed with breast cancer. She is cancer free now, thankfully. So, wow. But she was diagnosed with breast cancer, and it just really kind of made us reflect on life and take a step back and try to figure out what are we working for? Where do we see ourselves in, 5, 10, 15 years? And, what do we want to be doing with our lives, really? And so, for me, when you have an event like that happen, and it really puts life in perspective and how short, you always hear the cliche, right, that life is short. Well, when something like that happens, it truly hits you like, dude, life is short, right?
Yeah.
And you don't know, none of us are guaranteed tomorrow, right? So it just made me stop and reflect. And I always knew that larger multifamily complexes were something that would be a good investment and I wanted to get into. But I also knew I didn't have $3-5 million, whatever, to go do it. And so I just didn't think anything else about it, right? I just kind of let it go. But when that happened, and I was like, okay, I really want to pursue this whole idea of generational wealth, freedom of time, right? Allowing our family to spend more time together. One day, my wife being able to leave her corporate job and spend more time with the kids and these type of things. And so, it made me go deeper. And so then I just started listening to podcasts and learned that way, joined a local mastermind group where I was able to, be around people that were doing these kind of deals. And that's, to me, that was one of the biggest ways for me to get started actively in these deals and become a general partner, was being around people doing it. It kind of demystifies it, right? You've got people doing it, you learn from them. So that was probably the biggest game changer for me in terms of how I learned and the journey from that perspective. But that's how I got started. And so I've been a partner on eight different deals to this point. And recently launched a fund, and so those are, it's been fun, and I'm also exploring other different types of commercial investments. Definitely not looking at office right now. It's not a, there's I'm sure there's opportunities out there for those that know what they're doing. I definitely don't know anything about investing in office buildings, so I don't like to invest in stuff I don't really understand. And so there are some other types of real estate investments. They're called industrial service facilities, smaller industrial type projects that I'm looking at potentially partnering with somebody on this year. And those I've been passively investing in myself to kind of learn for a couple of years now, to kind of learn about how it works. And so now that I've learned a little bit more about these properties and how they work, that's probably something else I'm going to also invest in as well, and open up to my investors that are interested. But yeah, that's probably that was my journey in kind of how I got started in multifamily, and why I got started in multifamily.
Man, that's very powerful. So she had breast cancer in 2008. She's cancer free.
2018. Yeah.
Oh, 18. Okay.
Yeah.
So she's cancer free over the last 5 years or so, which is phenomenal.
Yeah.
And I love that story, that it kind of got you thinking, because I do feel like if you haven't had a life event like that, and maybe it's not you personally, like in your case it wasn't you as your spouse, or maybe it's a really close friend or family member, it's one of those things, oh well, it's not going to happen to me. But then when it does, you got to, like you said, take a step back and just reflect and figure out, okay, so what's our goal here? What do we want to do? And I do feel like a lot of times, people are, and myself included, just kind of moving forward. And then, you wake up 5 years later and you're like, oh shoot, I don't know what I want to do, or I don't know what my goal is. And so, fortunately she's cancer free, and kind of, that light bulb moment of, okay, what do we want with our lives? And you mentioned generational wealth and time freedom, and the ability to hang out with friends, family, people that are close to you.
Yeah. I just got to add, man, she was 38 years old when she was diagnosed. So, generally when you think of breast cancer, right, you think of older folks and stuff like that. And not only that, she had no family history. Nobody in her family that she knew of. Actually, her aunt ended up getting breast cancer after she did. So it was really, really odd. And just on a I guess as a PSA, right, for anybody that's listening that knows any women. Obviously everybody knows women, but somebody close, or if there's any women listening to this show, make sure you're checking yourself regularly, because the way she discovered it was she was breastfeeding and she had a clogged duct, and so she realized, that lump that she was feeling, she thought, oh, it's just from that. Well, when the clogged duct went away and there was still a lump there, she's like, oh, well, that's odd. And so then we were like, yeah, let's go get this checked out. And so, my point is that she wasn't checking herself regularly. And so had she not been in that circumstance where she was breastfeeding, she would have never found it, because she wasn't doing that. And not only that, it's so important when you're younger to be doing it too, because generally, and this is not always the case, but generally when you're younger and you get breast cancer, it's actually a more aggressive form of breast cancer as well. So the lump wasn't that big, but it had already spread to her lymph nodes as well. And so, it's amazing how fast it can happen. And so, just as a side note, just check yourselves regularly. And if you know somebody, mention it to them as well, because man, if just saying that can help one person, it's worth it. So just want to get that out there.
Wow. Thank you. Okay. So you took a step back, started reflecting, wanted to achieve time freedom, generational wealth, joined a mastermind, and you learned that you could invest in apartments, which, you don't have to have $3-5 million. Some of the properties that you've bought, that I've bought, you got to raise $10-20 million, right? And those used to just be for the ultra wealthy or these huge financial institutions to buy and work that magic and get cash flow, all that. But now, over the last, I heard about multifamily syndication probably 8-9 years ago. When I heard about it, I was like, no, there's no way someone like me can buy an apartment complex, right? And I know you mentioned eventually you want to get into some other commercial properties as well, commercial asset classes. there's no way that someone like you or like me, just a normal person, can get into these deals. But with multifamily syndications or these syndication groups, and I want to talk about your fund next, but people pool money together to buy these large assets, and you got a small team of general partners or active partners that run the deal, and then you have a huge pool of limited partners. Maybe 20, maybe 80 limited partners, passive investors. In some of our deals, I'm sure you could echo this sentiment as well, but there's nurses, teachers, doctors, lawyers, coaches. You don't have to be a billionaire or even a millionaire to join some of these, right? So I want to, like I said, want to transition into your fund. Is that relatively new?
Yeah, so I just launched that a month ago.
Awesome. And for the listeners who may not know what a fund is, do you mind giving an overview of what a fund is, and then maybe what your fund invests in?
For sure. Yeah, so a lot of people have heard of mutual funds, right? So you invest in a mutual fund. It's a group of stocks, right? This is similar. It's just not public, right? It's a private thing, and it's not stocks. It's real estate. So my fund is focused on 100+ unit apartment complexes, all in the state of Texas, all value add. I'm a big proponent of buying something at a discount or with an opportunity to force appreciation, because I'm not a big, and this is what got a lot of people in trouble back in 2007, 2008, 2009, when they were buying properties just for organic appreciation, right? That, to me, that's just gambling. So I always like to try to get something where there's an opportunity to force some appreciation. So all the properties that my fund will be investing in will be Texas multifamily, value add, and primarily focused on the larger markets. So San Antonio, Houston, Austin, Dallas, those markets. And it'll be anybody that is investing in the fund will be going back to diversification and how important that is. They'll be diversified across 5 to 10 is my target range of properties. So they'll be getting some diversification. Instead of putting, let's say, 50 grand into one apartment complex, right? They're going to be getting diversification, and that same 50 grand can be spread out over 5 to 10 properties. And you're not only getting geographical diversification, because these apartment complexes are going to be in different cities, but you're also getting sponsorship diversification, right? So there's a lot of sponsors. I shouldn't say a lot. There's some sponsors out there that have similar type funds, except when you invest in that fund, what you're doing is you're investing just with that sponsor and the properties that they have. So this way, you're also getting the diversification on the sponsorship teams that you're investing with. And the importance there is that, as you know, different sponsorship teams underwrite deals differently. I haven't seen any two. The general underwriting is the same, but there's little nuances here and there where they may do things differently. Some may be more aggressive than others in the way that they project out their rent increases or their expenses, things like that. And so you're getting diversification on a lot of different levels, and so that's one of the biggest benefits of investing in this type of a fund.
That's great. And so just to kind of recap that and maybe explain it in a different manner. Your fund, if someone invests with you, Brian, with your fund, they're not investing in one single deal. And that's typically in multifamily syndication. If we get a deal today, I'll send an email out and say, hey, we're opening up the subscription period. So Brian, if you're interested, let's talk, and we're going to have a webinar. And then, okay, Brian's interested. You wire the money over to the account, and you're invested in this one deal. But with your fund, Brian, it's not one deal. You're investing in multiple deals. And so if one deal for whatever reason goes sour, or maybe not sour, but doesn't quite hit the projections, you got 3 or 4 other deals to kind of balance that out. So it's right. You're probably in a fund like this, where you invest in multiple deals, it's less risk and probably less reward as well, right? Because from the standpoint that if you invested in one deal, it could go extremely well, but with 3 or 4 other deals, you should get a pretty good return overall, but spreading the risk out between several properties.
Yeah, the interesting thing is I wouldn't necessarily, so less risk, yes. I wouldn't say necessarily less reward. So, my fund is targeting 16 to 20% is our annualized returns that we're targeting.
Okay.
So if a deal doesn't fall in that range, I'm not gonna look at it. Um, so I wouldn't say necessarily that so I'm not, it's not necessarily a less reward. It's just you're getting the same potential potential reward, right? Because of the return range that I'm targeting, as you would if you were investing in one individual property. The only difference is that you're diversified. So the only thing that my fund is set up very differently from any other funds that I'm aware of out there, right? So there is an administration fee of 1%, that it's capped at 1% that my fund will charge, of assets under management. If it goes over 1%, I'm paying that out of my own pocket. If it goes less than 1%, so if the fund expenses for me end up being 0.75%, that's all I'll charge. It isn't meant to be a profit center for me. I have no management fees. I have no equity split. I have no promote. I don't have anything like that. The only money that I'm making in the fund is money that I've personally invested in the fund alongside with my investors, and I've already invested my funds in the fund.
Wow.
So there's not really any other funds out there like that. The other thing is, with my fund, I'm targeting writing. So just to back up for 1 second too, and this, there's my fund is going to be a limited partner in other syndication deals. Okay. So I'm not going to be a partner on the syndication itself. And there's a reason for that, and a very, very calculated reason, because I don't want to just invest in deals in my fund that I have to be a partner on. I want to be able to invest with the best sponsors and the best deals that are out there. I don't want to be limited to having to be a partner on a deal. And so really my fund is diversification and flight to quality. Those are the biggest things that I'm trying to do. So the deals that I'm investing in are with sponsors that have a track record, right? So they've gone full cycle on multiple deals. So they can show me what their returns have historically been, right? That are underwriting these deals conservatively, right? They're getting good loan terms, right? And they've got good reserves set aside. These are all valuable things that I've learned over the last few years that are just critical to these deals being successful, especially during a time like what we're experiencing right now. Because as you and I both know, right, there are plenty of deals out there that are struggling right now.
Yeah.
And I'll be honest, some of the ones are ones that I'm a partner on, right? We've had to pause distributions. They're fine. They're not, when I say struggling, it's just from a being able to pay out distributions and things like that we were hoping to do. They're doing fine from a financial standpoint. They're still secure and everything, but there's deals out there that are struggling. And there's some that have gone back to the bank. I know there was a portfolio in Texas, $300 something million portfolio recently,
Yeah.
that got foreclosed on, right? So it's really important that, and this is the other thing that my fund provides, is an additional level of due diligence as well, right? So I'm able to look at these deals and really understand, are they underwriting this conservatively? Or are they being aggressive? Are they putting in their 10% a year rent increases, right? Like that's not even realistic. So, so it's just, it provides that level of diversification. And because I'm going to be investing bigger checks into these deals, I can potentially get better returns than investors investing directly in a deal as well, right? I can negotiate better terms on some of these deals potentially. And so it's possible for an investor in my fund, if all goes as planned, that they could actually, by investing in my fund, get a better return than they would investing directly in a deal and be diversified. So it really, it really is kind of like, well, why? And there's still good deals out there for, if you want to invest directly in just one deal. Some people don't like not knowing what the future apartments are going to be that you're going to purchase, and not knowing where those are going to be and all that good stuff, and seeing those financials. For those folks, you got to stick to the single syndication and invest in those deals. And those deals are still good if they're with a good operator and a good team, right? But this provides that level of diversification that you don't get from that perspective.
Man, that's incredible. So your fund, I don't know if I've heard that before. The minimal fees, I love that. 1% is the highest that someone would pay. I've seen it as high as 3% or 4% in the past. And then there's a lot of other kind of gotchas here and there with, oh, well, we did better than we said, so we get a cut of that too. And so with you,
Yep.
yeah, and with you, not only because you have bigger checks, and so sponsors say, well, Brian has a fund and he has X amount of dollars, so we can give him a little better percent, some preferred returns there, because it's less work for the sponsorship team to have to go out and raise $50,000 for maybe 40 other people, right? And they just go to you for one check, so you can kind of negotiate better terms there. And then because they're paying less fees, the investors in the fund are paying less fees, they'll be able to keep a lot more of the money. And then you are only investing in deals with very experienced sponsors that underwrite extremely conservatively, have reserves, and have a phenomenal track record. That seems like a really good deal. And I know you said you're looking at 16 to 20% annualized returns there. Man, that's incredible. And so your fund kicked off a month ago. Is it live, or did you start the process a month ago?
Yeah, no, it's live. Already invested in a 360 unit deal in Dallas. That's closed. There's a 114 unit deal here in San Antonio that'll be closing toward the end of this month. Actually, I think next week. Yeah, no, wait, this week possibly.
Okay.
So already got two deals in the fund. And so yeah, it's live, and it's like I said, it's going to be a great opportunity. And the one thing, and you haven't asked me, but I have been asked, and I've gotten a lot of pushback from people on the way that I've structured my fund, because people have asked me, well, and this is not from investors, this has been from coaches that I've had and things like that are like, look, you've got to charge a fee, because people are going to be like, well, what's your motivation to do well? And I try to explain that, well, my motivation to do well is for one, I have my own money invested in the deal. And two, this is not going to be my last fund.
Yeah.
I'm trying to build up a track record in the fund as well. And so I don't foresee that my next fund that I plan to launch next year, I don't think that that's going to have just the 1% administration fee. There probably will be a management fee on that at that point as well. That's going to be a bigger fund. And so I'm targeting a $5 million fund for this first fund. So relatively small in the real estate space. And so, I've got a plan laid out. I've got a goal, right? That with complete transparency. With that second fund, I add in the management fee. Now my wife can leave her job, right? That's the whole goal here. And so it's really just, I'm all about transparency. So you'll hear a lot of people come on and not necessarily on your show, but on other shows, and talk about they've got this fund, they got all this, but they don't mention anything about the fees and stuff. I'm very open. I try to mention it on whenever anybody asks about my fund, I'm very upfront about that, because I think it's important. And you mentioned seeing some that are 4%. I've seen ones with a 2% placement fee. So as soon as you invest 50 grand, your actual investment is now $49,000, right? That's taken off the top, and so your investment's been reduced. Then there's a 2% management fee every year that's charged. And then there's like you mentioned earlier, kind of an equity split, right? So like a 95-5 or whatever equity split, meaning their returns are just getting diluted so much that at that point, yeah, it doesn't make sense, in my opinion, to invest in the fund. You should just go invest directly in the deal.
Yeah.
And so I'm trying to, take away all that. And quite frankly, between you and me and, well, everybody listening, I feel like a lot of people get taken advantage of, that don't know that they invest in these funds and they don't understand fully all of these fees that they end up paying and how diluted their returns end up being. And so I feel like people get taken advantage of a little bit too. And so I'm trying to kind of disrupt the industry a little bit from that perspective as well.
Man, that's great. And as you were talking, Brian, I kind of going back to the stockbroker or your financial advisor who takes a little bit, the company takes a little bit, the mutual fund, manager takes a little bit, and kind of seems the same way with funds. And funds aren't a bad thing. What it does do is it says, hey, and maybe someone who invests in one of those funds, they have the money, they don't have the time or the experience, right? And so they just say, look, I know you're taking money off the top, and that's fine, because I'm getting a much better return than I would if I went and did it myself. I don't have the time, money, or the time or experience, but I do have the money. So funds are not a bad thing, and we're definitely not saying that. I think what we're saying is Brian's is way different in a lot of different manners, and one of those is you're also investing alongside the other people that invest in your fund, and that's amazing.
Yeah, and I didn't. Yeah, sorry if I kind of made it sound like
No.
other funds are bad. Yeah, totally not. I mean, because the reality of it is, there's a lot of work to being a fund manager. I'm a fund manager on another fund as well, and there is on somebody else's fund, and there is a lot of work involved in this. And so, essentially, I'm working for free. But you can only do that. Not everybody can do that, and you can only do it for so long, right? And so, so it's not, there's absolutely nothing wrong with charging some fees. I mean, this is somebody's job. They've got to earn a living, and they are providing value for people, like you said, that don't have the time to go out and do this research and find these properties and do all that. So yeah, I definitely didn't mean to disparage any of the other fund managers out there, funds that are out there. Just trying to point out the difference between my fund and some of those other funds. But I will say, though, still there are some that are taking advantage of people.
Yeah,
in my opinion.
I do agree with that, but I don't think you came across bad at all. I just wanted to be clear there with, for the audience who maybe has heard of a fund or has invested in a fund, it's definitely not a bad thing. I think what I'm saying is your fund seems even better because you're not doing some of that stuff, but you're still providing the value and the experience and the knowledge and saving people tons of time. And you've been doing this for a while, real estate for 20 plus years. Multifamily for 5-6 years now. So you're very well connected, especially in Texas where you are and where you're looking. So that experience right there is extremely valuable.
And one of the things I was just going to add real quick too, and just so people are aware, one of the reasons, and there's other states that have great multifamily investment opportunities as well, but I'm really sticking to Texas for my first fund, mainly because, like you said, it's where I'm at, and I really understand the state, but it's just a great state from an investment standpoint. I mean, if Texas were a country, it would be the 9th largest in the world from a GDP standpoint, right? So it's just and very, regardless of what people's political views are, very business friendly. And so that just brings more businesses into the state, which then brings in more jobs. And so we've got so much migration into the state, over 1,000 people a day moving to Texas, that it's just a great state to invest in.
And you're in a very sweet spot in San Antonio, because that's one of the fastest big growing cities in the United States, I believe.
Yeah, and the cool thing about San Antonio is, and you lived out here at some point, so you can probably appreciate this too. It truly is a big city with a small town feel. Like you hear that a lot of places, but that is so true in San Antonio. But it has changed a lot. It's grown so much. It's been amazing to see. Yeah,
that's awesome. So I want to, I know you said that you have invested passively in tons of deals. How did you come up with the capital for those investments?
Yeah, so actually, that's a good question. So it goes back to my single family stuff. So what I did is I had invested in multiple single family properties over the years, and when rates were so low, a few years ago, I took advantage of that, and I did a cash out refinance on 8 properties. I did a cash out refinance on 8 of my single family properties. Got a 3.5% rate on a 30-year mortgage, which was amazing. And so I took that capital and started investing passively in deals. So I invested in it, and that's how a lot of people that want to do it actively start out. They start investing passively in other people's deals, because that's another way to learn. That's actually kind of missed out earlier when we were talking about how I got started. That was actually the first thing I did, was started investing passively in deals. But so I invested in a deal in Phoenix, invested in a deal in Orlando, and then a deal here in San Antonio. So I invested in 3 passive deals before I was a partner on any deals. And I'm a firm believer in, don't invest with somebody that's not kind of putting in some of their own money in deals. And so I've always put money into those deals as well. But yeah, that's kind of how I got the capital to get started in passively investing.
That's awesome. So you had 8 properties that you did a cash out refi. You were able to greatly benefit from the interest rate being so low. You probably owned those for a while, where you had a nice equity. And so you took that and reinvested that immediately. I invested in a couple passive deals when I first got started. Loved it, learned a lot, went to a lot of different webinars just to see kind of like what are other operators, what are other teams doing to create that value, to add value and boost the value of the property. And you hear a lot of different ideas, and we've taken some of those ideas in our active deals and replicated those. It's really nice to that these webinars that they want to tell you their business plan. They want you to invest, and they want you to learn and love the deal, right? Just like they do. And so been able to take some of that and use that on our properties. What would you say, and you kind of touched on it with the fund, with another fund next year, but what would you say your company goals are over the next 9 to 12 months?
Yeah. So, like I mentioned, the fund next year, the plan there is to have a $25 million fund, and then the third fund would be $100 million fund. So
Wow.
I've got some pretty aggressive and big goals, but if you don't put those goals out there, you're not gonna, you can't possibly achieve them, right? So, that's my plan. And then, like I mentioned earlier, I'm going to be partnering with somebody this year, probably on some of those industrial service facility type of investments as well. Those are in the Houston area. And so, those are going to be, and then I'll still probably be partnering on some individual syndication deals in the multifamily space as well. The thing is because of my background and having been a financial advisor and a stockbroker, I don't know, naturally, I've just always been very intrigued about different types of investments. And, I go to local meetups here in San Antonio, that talk about venture capital type investments and stuff like that too, which is a whole nother risk level and a whole nother type of investment and a whole nother podcast interview, right? But that's something that I've invested in as well to kind of get a better understanding of how those things work, and it's really cool. It's kind of like a Shark Tank, but just locally here in San Antonio, so it's pretty neat. And doing that, and I've invested in a lot of different passive things too. I invested in a Bitcoin mining fund, not going that well. Invested in a liquid crypto fund. That one's been doing all right. And a debt fund, debt consolidation fund. Just different types of investments to kind of be diversified, right? I think diversification is super important, and there's not enough of that. People hear about it, but they don't really appreciate it until you get into times like right now,
Yeah.
When things can be going south, and then it's like, oh crap, maybe I should have put something over here, and so that's kind of an inverse correlation to what I'm invested in over here that's so aggressive. So that's just the way it works. People don't think about that stuff until it hits them, right? But
Right.
but yeah, so that kind of tells you a little bit.
Very cool. Do you find that a lot of stockbrokers or mutual fund managers invest in real estate?
Some do. It's an interesting dynamic, especially in the financial. It's funny. I'll just tell this anecdote. So whenever I have an investor that's like, oh, that sounds great, that's awesome, let me go talk to my financial advisor before I do this. I'm like, okay, yeah, they're not investing.
Yeah.
Because and their financial advisor has to make money too, right? So I'm not trying to bash financial advisors, but they don't have an incentive to recommend that somebody invest in these type of products. I think a lot of times there is a subset of those folks that do, but most of the time they're so focused on their industry that they're not really looking a whole lot outside of that. And so I think that most probably, and I don't know this for a fact, but if I had to guess, most don't, because they're so focused on their industry and what they understand. It's funny. I was talking to somebody the other day, and I again, not to bash financial advisors, but I was trying to explain kind of how my fund works and everything. And I was like, so here's what I'm going to tell you to do. Go to your financial advisor, tell them I want you to invest in the exact same thing that I'm investing in, but only make money on that investment that you're invested in. And see if they'll do that for you, because the answer is going to be no. Right. And that's essentially what my fund is doing.
Yeah.
But again, they've got to make a living. And, I was in their shoes at one point. And so I totally understand where they're coming from, but.
Very cool. I know we have a few minutes left. Want to ask about a recent book that you've read or listened to that stands out?
Yeah, there's been a few. So I think one of the biggest ones for me was The One Thing, and I can't remember the author off the top of my head. But that book basically, it talks about focusing on your one thing, right? And because when you get too distracted and you're trying to focus on too many things, you don't spend enough time on that one thing. So that would probably be the most recent book.
Is that by Gary Keller?
Yes.
Okay.
Yeah, I think he's one of the authors on it. Yeah.
Very cool. The One Thing. Okay. And then what about, I know you brought up the funds and diversification. Anything else that people can expect to see from you and your business over the next few years? And those are huge tasks. I'm not saying those aren't huge. Just wanted to highlight any other goals maybe that you might have.
I think those are the biggest things. I think the other thing that I'm definitely exploring, I'm very passionate about the fact that a lot of folks can't invest in these deals unless they have. So as you know, there's different types of deals. You don't always have to be an accredited investor, but even when you're not accredited investor, you need to be sophisticated. And even at that point, you also need to have, $50,000 roughly, right, to be able to invest in a deal. That prevents a lot of people from being able to invest in these type of institutional quality type projects, right? Yeah. And so something I am exploring right now, and I'm in the early stages, but I'm hoping to be able to provide here in the next few months, is the opportunity for people, to be able to invest with a much smaller amount, that aren't accredited, that want to be able to invest and diversify into these type of investments. I feel like that they're really left out, and I think that's unfortunate. Yeah. And so that's another avenue that I'm pursuing as well. And so hopefully that's something that I'll be able to provide to investors in the near future also.
Man, that's huge. And so is your fund, does it have a minimum amount?
Yeah, so my fund is only open to accredited investors, and
Okay.
it is 50,000 is the minimum.
Okay.
But hopefully, fingers crossed, this other thing I'm talking about is going to provide another avenue for folks into the fund as well. But we'll see. We're very early stages on that.
Yeah, that's probably one of the biggest pieces of or biggest issues I see is, hey, I don't have $50,000, but I have 35 and or 20 or whatever the number is. Mm-hmm. And it's like, look, sometimes we can't accept that, and sometimes we can't. Then I get into you can only have X amount of sophisticated investors and mm-hmm. Unlimited accredited, and so I would also like to do something where we could take almost any amount and invest that, because I multifamily syndication had a huge impact on my life when I heard about it, and could, I didn't need experience. I could do this 100% passively, and I'd love to be able to share that with anyone. So I love that idea. Brian, what's the best way that people can reach out to you if they want to know more about you or more about your fund or interested in investing with you?
Yeah, I think the best way would be to just shoot me an email, brian@headstartequity.com. My website obviously is headstartequity.com, or they can hit me up on LinkedIn as well. That's the only social media that I'm on, so they could reach out to me that way also.
Perfect. And we'll put that in the show notes. I love that your last name is Head, and you started with Headstrong, Head Start Equity. Yeah, love that. I'll just say that was a tough name growing up. You can imagine a lot of ways to make fun of that last name. And so I switched it around and turned it into a positive thing with my company name. So awesome. I love that. Yeah. Well, man, thank you so much for being here, Brian. I learned so much from you, and I love the story about your wife being cancer-free and kind of reevaluating a lot about your future and the future of the family together. And I love that. Thank you for being here. It was a pleasure speaking with you.
Yeah, thanks so much, man. Thanks for having me on. I really appreciate it.
Thank you for listening to today's show, brought to you by H&K Investment Group, your home for passive investing. If you want to learn more about how you can invest with us, please check out our website at hkigllc.com. Don't forget to like this episode and subscribe to our podcast. Please leave us a review to let us know how we are doing.
Feel free to connect with me directly on LinkedIn or Facebook. As always, I'm your host, Charlie Hardage. Catch you next time.